In this video, we are going to look at a case study of a 38-year-old individual. Now, he's a dentist that actually owns 23 different locations. That is no easy task, especially before the age of 40. To do that, in my opinion, you have to, one, be very good at what you do, your specific trade, which he's a dentist, and then two, you also have to be very experienced and good at business, which if you own a business, you know that does not come overnight. There's a lot of growing pains, a lot of learning, and I could talk all day about that. But why he reached out was specifically for a whole life insurance policy, but he mentioned in his first email, I'm interested in the cash value benefit, which most people that reach out to us, that's exactly what they're interested in. How do I maximize the cash value in a whole life insurance policy? However, he had a follow-up question. He said, based on my age and income right now, how much life insurance do I qualify for? He had some life insurance in place already. Term life, he had been pitched on or sold on whole life insurance in the past, decided not to move forward with it, but he has this question. How much life insurance can I get? So as a quick example here, if he's age 38, so if you are age 40 or younger, it's age 18 through age 40, you can typically qualify for 30x your income. Now, you can add more life insurance to this. If I own a business, I can insure that. If I've got certain liabilities I need to cover, if it's a key man policy, it's an additional 10x. But most companies will permit 30x my income between ages 38 and 40. Some will go up to 35. And I can see that in the future happening with more and more companies. Once one does it, others usually follow. But the norm for a long time has been 30x income in total life insurance. So this individual, if his income is, let's say, $1 million per year, at 30 times that income, what is the total amount of life insurance, call it death benefit, that he would qualify for? $1 million in income times 30. Is a lot of life insurance, $30 million, which is paid out income tax-free. Income tax-free. If he had no other assets, this would automatically put him over the estate tax limit. So we do have to be cautious of that when passing on assets, because that would be subject to estate taxes unless it goes to a spouse. There's no concern there. But kids, next generation, there are estate taxes in that respect. But $30 million. That's the total amount of life insurance he would qualify for, and that's with all companies and all policies combined. A question we get sometimes is, hey, if I qualify for 30 million, and if your income's 100,000, then it's 3 million. If your income's 10,000, then it's 30,000. The 30x is consistent. But a question we get is, hey, if I qualify for 30 million, could I take that out with company A and then take out another 30 million with company B? And my answer is, that'd be nice. But unfortunately, no. The limits are based on all life insurance policies we have combined, whole life, term, all of that good stuff. So there is the answer to his follow-up question, how much death benefit can I get? So let's progress on here. The funding that he is interested in. During our first Zoom call, he was interested in funding a policy at up to $100,000 per year for a maximum of 10 years. So throughout the conversation, I asked a couple times, how long do you want to be able to pay into it? And 10 years came up. He's like, I really like the idea of funding it for 10 years and then being done. And a follow-up question I always like to ask whenever I hear that is there any chance that you want to fund longer? So let's say you fund it at $100K per year for 10 years. Once you hit that, do you think year 11, do you want the option to continue to pay into it, or do you want to stop altogether? And the response was, probably not. We get this response from a lot of people. However, are there any advantages if I do keep paying into it? Like, what's the difference if I stop after 10 years or if I want to keep paying into the policy? And the answer is, when you look at a whole life insurance policy, specifically designed for cash value, what's the worst part about it? The first year, right? The minimum premium does not show up in cash value. I have less money than what I pay into the product. If I pay in, call it $100,000, for example, your first year cash value is going to fall anywhere between $80,000 and approximately $90,000 in the first year. So I take a hit. What's the best year about a whole life insurance policy? Every year after the first year, because I get more and more of my money back. It begins compounding, all of the good stuff we talk about all the time. So At year 10, or I should say at year 11, if you feel, hey, I really like this policy, it's really compounding nicely now, I do want the option to keep feeding the beast, that would be an advantage of having a policy where you can continue to pay into it beyond the 10th year. Now, on the flip side, there is a drawback to that, or another item I should be aware of, is funding a policy for 10 years or less will often enhance the internal rate of return. Just if I said, hey, here's the dollar amount I want to get in, say it's $1 million, whatever the dollar amount is, I get it into a policy and then I'm done. Like, this is what I'm interested in with this product. If I do that, if I fund it for 5 years, 10 years, and then stop, you will see the internal rate of return often optimized both on cash value, sometimes on death benefit. Long-term death benefit, yes. Short-term death benefit, no. Cash value, always. So, pros and cons, there are advantages and disadvantages. Another follow-up question he asked was, can I just give you a lump sum of $1 million? Can I just pay it one time? Like, if I've got $1 million, can I pay it off all together? The answer was yes, but it makes sense to spread that lump sum out over 3 to 4 years. 3 years would actually look pretty good at his age. It would look better than 4 years when looking at the non-guaranteed values, the current dividend rates. But if we look at things more conservative, kick dividends down, look at the guarantees, spreading it out over 4 years makes more sense. So he had this question. We want to show both options. $100K per year for 10 years, total of $1 million. $250,000 per year for 4 years, total of $1 million. From a pure cash value efficiency standpoint, which one do you think gives you more money? $250 over 4 years. You're getting more money and faster, begins compounding, and you'll see just when you compare the two side by side, you've got more cash value and more death benefit long term with this. So definitely more efficient. However, comfort level also comes into play. So specifically, when we look at policy design, if we take these two options, how they're set up, you've got the 100K option set up as follows. We ran different samples, Mass Mutual and Guardian, two of the 4 major mutual companies that offer flexibility. At the 100K per year option, he's not billed for $100,000. And this was a piece that he really liked. He said, oh, I thought if I go with a 100K option, do I have to come up with 100K each year? He alluded to something like that. We met, it was about a month or so ago, so don't quote me on that. But he was attracted to the idea of not being committed to the full $100,000. He can commit just to $10,000. This way, it never feels like a burden. And then 100% at discretion, he can just throw more money into PUAs for the other $90,000, or very close to it. The premium, there'll be a term rider attached to that as well, so his true minimum commitment might be $11,000. My point is minimal commitment, and he can just pour excess funds in at leisure up to a total of 100K per year. Now, Mass Mutual is a little bit more regimented. When I say at leisure, you can only make payment adjustments one time per year. Guardian, you could do just this, commit to the minimum only and throw excess funds in whenever you want. So that's with 100. If he went with a 250K maximum, here's what it would look like. Same concept, ratios are all the same. $25,000 minimum, might be 27 or so with the term rider. Term rider is a means to raise the death benefit, which raises our MEC limit, that IRS limit. And then at discretion, you could just throw more money into PUAs. But that's his minimum commitment there. So in a case like this, if this is similar to your situation, whether you add a 0 or take a 0 off, the comfort level there. I like the idea of a cash value life insurance policy being safe, liquid, tax-free, all of that fun stuff. But what am I comfortable with respect to a minimum commitment? This way it never feels like a burden. I can really use it as a flexible savings asset. So I like to ask that question. Now, if you're in a case where you say, hey, I've got the $1 million on hand right now, doesn't really matter, but it is good to still ask this question, or I like asking it for this video because everyone's in a different position if you're watching this video. So, main points we're going to touch on here. 1, simplify, and then 2, look at the pros and cons of different companies and products. Simplify. So, we put a couple different scenarios together for him. The first one, I did my normal thing with a ton of information, and he said, simplifying might help a little bit. He was very nice with the way he said it because I sent everything. First he said, thanks for the info. It is a lot. I'm still reviewing. So I saw that was a text message and I kind of read into it. I'm thinking, okay, if I sent that to someone, it would mean that someone sent me too much information and I don't really have the time because I'm running 23 different offices to try and really dig into it. So I messaged him back and I'm like, no problem at all. Take your time. If it's easier for you, I can put a simplified version together. I know you've got a lot going on. I get a message back. Simple might be better. Okay, that's all I needed. Let's put a condensed version together, which is what I'm going to show you when we go through everything here. But I've got a problem where I like going into the details, as you can probably tell through the 10 minutes of this video already. Pros and cons of different companies and products. So we mentioned Mass and Guardian. What we put together here are different options as follows. With Mass, we ran 3 different products actually. They're high yearly cash value product, which is great for strong upfront cash value. And it's also a nice option if he wants to fund beyond the 10th year. He said probably not, but I did run this as an option for that. Then also their 15-pay product, which allows you to pay into the policy for a maximum of 15 years. Both of these options will allow you to make payment adjustments without any medical underwriting 1 time per year on the anniversary date. So as an example, year 1, he can pay in $100K. Let's say he pays in actually $100K years 1 through 5. And then let's say 6 through 8 for 3 straight years, he just pays in $30K. What he can do with these 2 MassMutual options, with the way he designed them, is year 9, he can go back up to $100K. He can even make up for lost time and pay in the extra $70,000 for the past 3 years if he wanted to, through a MEC catch-up payment. But he can scale that payment back up without any medical underwriting. A lot of times insurance companies will require that you go through underwriting if you want to add more money to PUAs, or if I go down, then come back up within a certain time frame. All companies have different rules. If you use the proper riders, you can make a policy that's typically not flexible, like MassMutual policies, and make them very flexible. So those 2 have a lot of flexibility. Then we also ran a 10-pay product with minimal, almost no flexibility. But why we did that is because it produced the strongest internal rate of return. Gave him the best bang for his buck when we look at how much did I pay in and what's the cash value growth. Then we also looked at Guardian. We looked at one option over here, one product I should say, and we ran that with the basic dividend rate and also that indexed feature, which is a rider we can attach to the policy. So that's what we looked at there with respect to pros and cons. So advantages to MassMutual, like the 10-pay, for instance. Pro, strong IRR, rich cash value. Con, what's the drawback? Lack of flexibility. The other 2 products, you've got flexibility, but it does lack a little bit when we look at Guardian. So as an example, Guardian allows you to make PUA payments at leisure. However, the sweet spot with Guardian is if I said, I want to 10x my base premium for 10 years or less. After that, I want to stop, or maybe I just pay 3x my base premium, a reduced amount. Has to do with their contract language, the term riders, and some other things we've got in our All About Guardian video. But pros, very, very flexible. Funding it for 10 years or less is the sweet spot in my opinion. Cons to a Guardian policy when maximizing the cash value is if I want to continue to pump in a heavy PUA payment beyond the 10th year, can become problematic. You can do it, but you can need a large term rider. It doesn't always make sense. So kind of how he is approaching this when we look at the main points. Save money. I have money in cash. I've got my business. I like to have control of it, even though I probably don't need it at all. I just would like somewhere to position my cash. Life insurance attracts me. So I can put money over here, probably won't use it. If I do, I might use it for my business because that's been his money driver. He likes to use money for his business. Maybe he wants to open more practices. I didn't ask that question. But if he does use it, He was interested in this guy, a cash value collateral loan at a lower loan interest rate. So, time to look at some numbers. Let's have some fun here. What we will begin with are 4 different options up here, but in a simplified format. So when I say simplified format, on the far left, we've got a high early cash value product. All of these are the 10-year funding, 100K per year. So you've got the high early cash value policy, which has a $10,000 minimum premium. 100K goes in. What's your first year cash value? 92% immediately. That's the immediate equity at the end of the first year. The beginning of the first year, day one, you might actually see $89,000 to $90,000. Now, as he continues to pump money in, what's highlighted in yellow represents the break-even point, when I have more money in cash value than what I've paid in. Year 1, I'm negative. Year 2, actually, we don't have the annual internal rate of return here, but we're still negative that year. What I mean when I say that, we're earning less than what we're paying in. My cash value is 92. You paid in 100. If you earned 0% on that, the 92 would grow to 192 and change. If you earned 0%, if you just got your 100K back. However, you paid in 100K, you've got 189. So you get most of your 100K back, but not all of it. The reason why, when we look at premium dollars, where the biggest bite comes out, even with the high early cash value, is in the first and second year. And you'll see that more so with the other examples. As each year passes, more and more of that premium comes back. Also, the compounding masks it because I'm earning interest on my cash value, and it gets better and better. As an example, year 3, 300,000 paid, grows from 189 to 289 and a little bit more. And then between years 4 and 5, I've recaptured everything, made up for lost time. I've got more money in the product than what I have paid in. After 10 years, paid in a total of $1 million. I've got another $139,000 there. That's the high early cash value product. Now, this is a great option if you want to fund a policy for a very long time. It can go up to a maximum of age 85. We could also consider their Whole Life 100, Mass Mutual's Whole Life 100, which allows you to go up to age 100 if you want to. But 10 years, like that's been his stopping point, at least right now through the conversations. He's like, I like 10 years. So 10 years, stopping there. Let's progress on to the 15-pay product. Here we go. 100K per year for 10 years. First year cash value, more or less than the high early? Less. Not a whole lot less, but it is less. I pay in 100, I've got about 85. Year 2, I pay in 100, grows from 185 to 179, so that's less than what I paid in. The next year, I get more back. Now here's what's really interesting. Let's circle this in blue. Year 5, these two are about identical. And from year 6 onward, just comparing the same company but different products, that 15-pay gives him more value. So the question I would ask if someone's trying to refine their decision-making process here and say, what's the difference? Because both of these are equal with respect to minimum premiums, always driving them as low as we can to beef up efficiency, is you've got more money over here in the first 4 years with the high early cash value. When you look at the difference, take the first year, for example, there's about a $7,000 difference. If I'm you and I'm looking at this, I'd say, okay, I've got about a $7,000 difference. If that's material to me, where I feel comfortable having access to that, I just want to see it there, then go with the high early cash value. If you said, I'm not going to use that additional 7, or there's a slim to 0% chance that I'll actually use it, well, then I would probably go with the 15-pay, knowing that it will quickly overcome that high early cash value product. And then by year 10, I see a difference there, getting close to $20,000 and gets stronger and stronger over time. Then you've got the 2 options with Guardian, their L95 product. When I say 2 options, it's actually the same option. One with the indexed rider, one with the dividend. And here's really the advantage. So option C, in an attempt to simplify things, you just add bullet points. Maximum flexibility, committed to 10K per year, option to add up to a total of $100,000 at leisure. So there we go, 100K per year, breaking even just about year 5. Let's make sure we go through the same exercise here. Actually, year 1, paying 100K, I've got 82,000. Year 2, paying 100K, grows from 82 to 180. I didn't get my full 100 back. Still negative. By year 3, I'm positive. One thing as well, when you look at the indexed illustration, so with Guardian, the indexed rider, when we attach it, cannot be exercised, will not actually go into effect until after the first 3 years. Policy year 4, you'll see it begin to become credited. And actually, it can start year 1, but if we add their term rider with a death benefits level, which permits me to pay 10x, then that indexed rider is not credited until year 4. So we've ran the indexed feature beginning day 1 with this illustration, but you'll notice that the values are identical the first 3 years. Beginning the 4th year, that indexed illustration looks better. Now with that said, it is an illustration. All of these are illustrations. Will they come true? No. If I see one product deliver greater cash value on an illustration than another product in another company, does that mean that's the option to go with? Absolutely not, because the companies always go back and forth. I do mention this quite a bit. Actual internal rates of return, historical performance, real proof of performance, that's what I want. And we've seen it with the 4 major mutuals, particularly with low premium policies. So there's the 1 million over 10 years. Let's look at the lump sum scenario, shall we? Here we go. 38-year-old male, $1 million lump sum, Mass, Guardian. Starting with Guardian, we've got the same product actually, L95, dividend index. That option I like with them quite a bit. It's a nice hybrid, I'll often refer to it as. The reason why is the base premium, the company overcharges for that only in the first year, whereas most traditional policies, they overcharge in the first and second year. But if we're funding a policy for 10 years or less, and then we pay just the premium or consider a reduced paid up option, what you can do with this L95 product is often generate stronger upfront cash values and internal rates of return, but also stronger longer term IRRs. Now, if I want to keep paying a heavy dollar amount in, some other products like their L99 will be better suited, but depends on my situation. But this is a nice option I like quite a bit, especially in a lump sum scenario where I've got the option to keep paying in dollars, perhaps just the premium from that point onward. But as we look at these two, so dividend and index, and then we've got their 10-pay product. So limited flexibility, but maximum internal rate of return. Really, what I would emphasize with this option is if he said, I'm comfortable with this, and I don't need or want the flexibility. Like $1 million per year, Steve, that's good for me. Let's move forward. I mentioned the flexibility. I don't need it. Like I can send the whole amount in at one time if I want. If someone's in that position, whether it's $1 million, 100,000, 50,000, whatever, that's where this product can work quite nicely. Look at that. Has the strongest long-term internal rates of return. Also strong upfront cash values, breaks even year 4. What happened with this product is with the 7702 change, Mass Mutual and most companies increased their PUA fees. This product did not experience a PUA fee increase. The same is true of the 15-pay product. But as a result, we can see just about 90% right off the bat, 225 would be 90, positive year 4, and keeps cooking. Which, hey, if it keeps cooking, I'm good with that. Shall we scroll down a little bit? Yes. Let's look at one more thing here, actually, when we compare the growth rate, because this compares the cash value, which is nice. Year 30, 3.36, dividend, 3.15. Got the indexed illustration, which is based on S&P 500 history, so I'm not a big fan of that. Not that I disagree with it, but I don't like looking at the speculation, especially with a fixed asset like this. But over 4.1. In any event, let's measure the internal rates of return. So where we mentioned 90% would be 225, negative 10% in the first year, 10.37 to be precise. Let's look at the Guardian, negative 17. Same with the indexed, and where you see the difference, beginning year 4, because that's when the index can begin to be illustrated. And will it do this? Maybe not. Could do worse. Could do better, actually. This is the highest we can illustrate it. But our Guardian indexed rider video, or indexed feature video, I should say, goes through the pros and cons of that rider. There are fees. When I exercise it, if I attach it and never use it, if I keep it at 0%, there's no fees. So I can attach it in case I ever want to hit the button, and there's no cost for that. If I ever hit the button, then I give myself the potential for greater upside, but at the same time, I do have the potential for downside. I can't lose money with the index strategy, but if the market flatlines, I only get the guaranteed rate on the whole life insurance product. With the fee, it can hurt me more than it can help, or it's not as attractive as a basic dividend-paying whole life insurance product. A lot of info there. Hope you enjoyed it. I always love talking about that stuff. If you have questions, would ever like to discuss cash value life insurance, feel free to reach out. If you enjoyed the video and watched it through the end, thank you so much. Please hit the like button, subscribe for more, and I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.